If
Mute yourself.
I
Mute
was not
yourself.
hearing before.
Mute yourself.
Hello, can you hear me?
I can hear you. Mute yourself so you can listen to what I'm saying. So I'll just rush through the introduction. I was talking about structure. That in structure, you have price moving in this direction. You can say that this is an uptrend. This is an uptrend because you have what? Higher high, higher low, higher high, higher low. This is what the trader expects to see in the market. In the other side, you also have what? Initial high, initial low, lower high, lower low, lower high, and what? Lower low. This is what a trader expects to see in the market. But in the recent, this is more like what we normally see in the market. This is what we normally see in the market, where we see price moving up and moving down. We see price moving up, moving down, and then this is what we normally see in the market. This is what we see every day in the what? In the market. We see all of this every day in the market. So this is what you normally see in the market, where we see price moving up, moving down, moving up, moving down. So we have a couple of uptrend, downtrend, consolidation, and all the rest of them. So now, and I said, what is common among all of this you see in the market every day? What is common among all of them? Something is always common among everything you see here in the market. This is a lower high. This is a breakout structure. So he started saying that there's a trend, that is this, that is that, all of them. But you can see that there is something that is common among all of them. What is it? It's what? Breakout structure.
Sure.
So there is always a breakout structure. And then whenever you have a breakout structure, most times, not always, most times you normally see this kind of pattern where you see this kind of A, B, C, D. And you expect price to do what? To pull back. So now this is what we call major structure. We call this a major structure and we call this a minor structure. This one is a major structure. Why this is a minor structure? This becomes a major structure when it has fully mitigated everything here. When this structure, when this point mitigates everything here, it becomes what? A major structure. If not, it is now a liquidity trap for price to come into and then be able to do what? Take out all of this. But this is another section of this one. So I'm trying to make you understand that whenever we have a break of structure, sometimes we normally see this kind of pattern A, B, C, D. So that's what I'm saying, that ABCD pattern is a kind of is from the family of harmonic what pattern. Harmonic patterns will have different types of harmonic patterns and their formations, all based on their measurements. We have the bat pattern, galley pattern, crab pattern, butterfly pattern, and so many of them. So this ABCD pattern is just one out of the so many patterns. And why I was trying to make you understand that before then, around 2019 or thereabout, most investors and traders, what we are looking at is support and resistance. Support and resistance, talk about key level, trend line, and so many of them. Chart patterns like head and shoulder, invert head and shoulder, and so many of them. So there was no consideration for imbalance, break of structure, inducement, other blocks, and all the rest of it. These are new concepts that came out newly, and people are beginning to adopt and see that it makes sense. So now, if you go back to the patterns, there was no main mention of other blocks. There was no main mention of breakout structure. There was nothing like that. What you will see is the higher high, higher low, and all the rest of it. But you don't see all these new concepts. So I was able to incorporate breakout structure. I was able to incorporate imbalances. I was able to incorporate other blocks and key levels. Key level, I mean support and resistance line levels into this pattern or into this concept or into this strategy. So it is from this place that bettered what I mean ABCD smart money concept strategy. So that is how it all started. Because in all of this, something is unique among all of them. Because if you open a chart or if you open an asset you want to trade, you get confused. Ask yourself, where am I going to start? Some of them have talked in the past, oh, you have to see liquidity. Some of them have different ways you trade. You see, you have breakout structure, price, speed this liquidity, break structure to the upside, and give you inducement, move up, breakout structure, comes back again to take this before going up. What is common among all of these? Break of structure. There is always a break of structure. And after that break of structure, what do you see? A, B, C, D. Even when it's coming back here, I'm selling here to this place to buy up. Because as it's coming here, it's also making another A, B, C, because it will not come straight here. Price will not come straight. Sometimes it will create a point. You will see this kind of thing happening where price will do this kind of thing. You see, we'll have a break of structure here. See for liquidity, movement liquidity, break of structure, price will do this kind of thing before coming back here to do this. So even as price is coming back to, I mean, those are trading kind of strategy. It's creating A, B, C, D pattern. You are selling from here down, or A, B, C, D. You are coming, as it's coming back to take this order, it's also creating A. So I'm selling here. I'm also buying here because this is my A, B, C, D. So there's break of structure here, there's break of structure here, there's always a break of structure. There's always a break of structure. That is what is unique among all of them. What? Break of what? Structure. So break of structure is always unique among all of these things you are seeing in the market every day. You will always see break of structure. So among all these break of structure, we now look at this ABCD pattern. So based on the measurement, that is when we can consider that this is a valid ABCD pattern to take. So it's not all the ABCD pattern we trade. We look at the ones that meet our criteria for us to do what to trade. So this is the origin of ABCD what pattern. Then now ask yourself, why this strategy? Why ABCD pattern? Say that it's what? It's a kind of a swing strategy in the sense that it is a strategy that you have to be willing to hold trade for a longer period of time. So because of what? This strategy is based on daily key levels. It's based on daily price action. It's fully based on daily price action. So all the support and resistance line, all the other blocks, all the imbalance field are all based on what? Daily price action. Less trade. Of course, because it's based on daily price action, you have less trade every week because a price, it takes days to break structure on the daily time frame. So it's not something that you expect price to be breaking structure every single time on the daily time frame. So you should be able to hold trade for a longer period of time and you have less trade because it takes more candles to break, it takes more price action to break structure on the daily time frame. And to be able to give you that unique symmetrical ABCD pattern you're looking for. Another thing is that it's no complicated stuff. There is no complicated. So we're only taking one aspect of the market structure, which is what? Break of structure. So we're not looking at the sweep or liquidity. We're not looking for inducement. We're not looking for a high. We're not looking for a low. We're not looking for all of that. All we need to know is there is a break of structure and price is reacting from a daily key level of either support, resistance line, or other block or imbalance field, and then price is giving us a reaction on that level for us to be able to do or buy or sell. So that is all we want to know. That is all we want to do. That is all we want to trade. Measurable. So the concept is measurable because the ABCD pattern that is formed, we have to measure it using Fibonacci, which I'll go in the next session to look at the C points. Most importantly, the C point, we need to measure it to know if it actually meets our criteria. The next one is what? Higher time frame support and resistance, order block, and imbalance. So I've talked about that this method talks about higher time frame, daily support and resistance levels, support and resistance levels, order blocks, and imbalance field. So that is all about the strategy. That is why we need to consider. That is why I'm considering this as a trading strategy. Now, let's go to the characteristics of ABCD pattern. So now this is the characteristics of ABCD pattern. We say that the ABCD pattern, there must exist what? A break of structure. So there must exist what? A break of structure. The A point must not, so as I'm explaining, please keep your questions, be writing them down. So at the end of the stuff, maybe in the next 10 minutes, I can be able to answer your questions. There must exist a break of structure, which we normally see here. So this is a typical example of ABCD pattern. The A point must not have any other unmitigated area residing below or above it. That is, the A point is the major liquidity which we expect price to respect. The A point must be within 0.786 Fibonacci level for buy or within 0.236 Fibonacci level for sell. Measure from high to low, vice versa. So let me explain this concept now. Let me know if I have any screenshots. I don't think I have a screenshot right here. Coming
Okay.
just 1 minute. Let me just see if I can be able to get a screenshot of price and why. 1 minute. Okay, let me see.
With you.
Let me share this. Okay. Yeah, can you see this?
I can see your chart.
You can see this, right?
Yes.
Okay, fine. So we are saying that the A point, the A point must not have any other unmitigated area residing below or above it. So you can see from this example, we have A, B, C, D pattern. And this A point, there is no other unmitigated. In fact, this A point came here to mitigate something. That is why you have this price. So above this A point, there is no other unmitigated imbalance or other block above it. So we now have A, B, C, D. And then this D came to do what? To mitigate a higher time frame what? Imbalance or other block. That's why we have this D. And we got a reaction here because of what? When price came the first time, this is the reaction we got. And then it came the third one, creating this what? This what we call rejection block, which we're going to discuss in the D point. Then we'll have this push to the upside. So we take our entry from this level, place our stop loss
Change your
below here.
comparator.
I've not gotten to that, please. I'm coming. Now you have break of structure. We have a break of structure here to confirm. That's what confirm this C point. And then we enter here and then we go. So what I want to explain to you is that the A point must not have, and then when we not want to choose this one as a, we make sure that there is no unmitigated. Even though there is unmitigated, we know that if you are selling from here, price is likely to come to clear all this liquidity here. And as it's coming down, it's also creating another A, B, C, D pattern. You can see that its price is going up. It created another A, B, C, D. We have what? A break of structure. Then price reacted from this what? Imbalance fill. Fill this imbalance, gave us a reaction, and it was a sell. And this sell took about 5 or 6 days. So what I want to explain to you is that you must have what? A, B, C, D pattern. You will always see it every time. And the A point must not have an unmitigated area residing below or above it. So this is what I want to explain to you. So if you are showing me your A point, you must make sure that you include that area of unmitigation, or even your D point. You must make sure that your D point include that area of unmitigation. I think I need to add that to the D point as well. So let me share the other screen with you.
Okay.
So you must make sure that that's what happens. So now here, the B point is the external liquidity, which we expect price to raid and create a new structure. So we expect price to raid. What I mean by raid means that we expect price to break above this B point before we can be able to confirm what C. Now, the C point must be within 0.382, 0.618 Fibonacci level. Also, it is usually the liquidity building zone for price to move to point D. We can also take a low risk trades from C point. The C point is confirmed after break of what? Structure. So let me explain them one after the other. Now, what it means that the C point must be within 0.382 and 0.618. What it means that if you take your Fibonacci level or Fibonacci 2, you go from point A to point B. This retracement must exceed 0. If you have B point forming like this is not a valid C point. It's not a valid ABCD pattern. It must either be at 0.618. That means either the body of the candle or the body of the candle or the wick of the candle must touch 0.382 beyond it. It can even come down to this place, it's still valid, but it must not it must not be above 0.382. Measure from A to B. So that's what he's trying to make you understand.
I'm with you.
So now, that is that about that. So they also, it is usually the liquidity building zone for price to move. Yes, of course, before price can be able to break structure, it needs liquidity, it needs money, it needs fund, it needs order. So price cannot just move without without you know without money, without liquidity. So without liquidity, there is no movement in price. So price will take a little pullback, a minor structure pullback, build enough liquidity within this zone before pushing to the upside. It was even yesterday I discovered that, oh, this is what really happens. Wow. So why is that price doesn't just move straight? So why is that price doesn't just move straight from why is that price doesn't just move straight from this point to this point? Eh?
Because you are seeing candlestick price is seeing money. So you won't go
Exactly. So
collect
price will
money.
just come here, mitigate some, takes money here, come down here, build enough liquidity here, either push down, break this guy, or break this guy. And this is what we want to see. So that is what happens in the market. If you go back to your chart, you see that this is what happens in the market every time. So this is what happens in the market every single time. So this is what we want to trade. So the C points, we can also take a low risk trade from C point. Yes, you can take a trade from C point. You can buy from here and target what? Best target is always, if you're buying, best target is always B, because we have not created D. So I said and targets C points. Okay, you can also take a low risk trade from C points and targets B and targets B. Okay, you can take a low risk trade from C and target what? B. Okay, so now if you have a lower time frame shift, we're going to talk about entry. You can take a trade from C and target B while we wait for D to be created. So that's what I mean by that. The D point is the potential reversal zone. That's what we call the D point. This D point, we call it the what? The potential reversal zone. This point. It is the point where we want to take our trade. This is the point where we want to take our reversal trade. And this D point is likely to create a new, where price is likely to create a new structural point of either higher high or higher low. You know that now we have, here we have what? Initial low, or whatever you call it, but then I'll call it a higher low, we'll have a higher high. Then we'll have a higher low. Then we'll have what? A higher high. That's why I said that the D point is where price is likely to create a new structure point of either higher high or higher low. So that is all about that. The D point must be reacting from a strong level, daily, weekly, monthly support, resistance level. A plus setup if the D point forms a rejection block on the daily time frame. I call it rejection block, in bracket timber. I'm going to explain to you what I mean by that. So the D points must be reacting. So for you to confirm your D point, first of all, you must have an order block or imbalance here on the daily time frame. that the D point is coming to, is that price is coming to mitigate. So from the left, on the left, if you look on the left, I told you about old price actions. So these are old price actions, and then price is coming to mitigate this thing on the left. It is still open. Let's say we'll have an order block here in balance field. So price is coming to mitigate that order block and imbalance field here.
Okay.
So price is now coming to do what? To mitigate it. So as price is coming to mitigate it, say you have something like this. So this gap between, for you to have an imbalance, it must be 3 candles. The low, the high of the third candle does not touch the low of the second or the first candle. The high of the third candle does not touch the low of the first candle. This small gap between these 2 candles is called an imbalance. And this last candle here is called an order block. So now for your D point, that means there is an imbalance here, or there is an order block here, which price is coming to do or to mitigate. So as price is approaching this imbalance and order block, you have already mapped it out and waiting for price to come and react from here. So price can be able to react from here. So the confirmation we're going to get here is on the lower time frame, which is the 2-hour time frame. So we'll be expecting 2-hour. So we'll be expecting a 2-hour structure shift for us to be able to sell from here to C point. So that is the stuff about ABCD pattern. Now for our entry and our take profit level. So our stop loss. Now, stop loss, you have to look at the market. If there is no condition, but the minimum stop loss level we are looking for is 50 pips. 50 pips from entry, 50 pips from entry. But then you have to look for, you don't have to look at your structure very well. Look at the level of, here. If you have entered here, you know your stop loss will be below here. So stop loss 50 pips. Then if you are selling from here, your target is always at C. Target is always at what? C. So your target is always at C. So target is always at C. Same for bearish. Target is always at what? So if you are buying from here, target is always at what? C. So the same thing, the same concept. So this is how we look at it. So please ask your question before we go into the chart and look at chart examples so you can become more clearer.
Sorry, I mute the mic. I don't know. I was talking to myself.
Okay.
So I say if we are selling, the target is usually at C, but if we are buying, the target is usually at B.
At C.
Right?
At C. This is A, B, C. D. Target is always at C.
Okay.
A, B, C. Target is always
Okay.
at C.
Okay. Okay. So the target is always at C, whether
Yes.
buying or selling.
Yes.
I think we can continue.
Okay, so let me share. You can see the Telegram bar.
Yes.
Okay. So first of all, let's look at what do you call it? Let's look at imbalance. Now, this is not a valid imbalance. Do you know why? This one is not
Which
valid. Do you
one?
know why? Because this third candle did not take out the low of this middle candle. So this candle did not take out the low of this candle, even though we have a space here, but then it's not a valid imbalance. It's not a valid imbalance. It's not even a valid order block. It's not valid because this candle did not take out the low of this candle, so it's not valid. So we
Okay.
expect this candle to take out this low, so can be able to have this kind of structure. But since it failed to take out the low of that candle, this is not valid. This one is valid. So for your imbalance, it's going to be from this point to this point. This is your imbalance. Why this guy here is your order block. So if price is coming like this now and pushing up, this is your order block. This is your imbalance. So a valid order block must have an imbalance before it. So if you're showing me an order block, there
Okay.
must be an imbalance before it. So if there's no imbalance before that order block is not valid. So if I show me an order block, make sure that you have an imbalance before the order block. This is an imbalance. This is the order block. So it's valid. Am I making sense?
Yep.
So now this is let's assume you just come into this chart now and they say you should analyze this chart. You should take your trade from this chart. What will you do? You'll be confused because you have a lot of candles moving up and down, a lot of structures, right?
Plenty.
Now, someone can ask, okay, fine, you should be able to look for sweep or liquidity, look for inducement, look for break or structure, and then wait for price to come and mitigate it, blah, blah, blah. And you start asking yourself, how am I going to start, eh? But then I can see my ABCD pattern here. I can see them here. I can see them here, plenty. I can see them here, plenty.
Yeah, show me.
This is a break or structure. We have A, B, C, D. This is a break or structure. We have A, B, C, D. Probably there should be something here on the higher time frame that price is mitigating, pushed up. This is a bigger structure. We have A, B, C, D. Break or structure, pushed up. A, B, C, D. Break or structure, push up. Let me go back. Hmm, good. We have A, B, C, D, break of structures. It can be from here. It can also be from here. We have A, B, C, D. Break of structure. Price reacts from higher time frame, imbalance, or other block. Is there any break of structure here? Here, there's a break of structure. So we can have A, B, C, D. We push stop. Even here too, we have A, B, C, D here too. A, B, C, D. Break of structure. You can see that if you open this, you can see that we sold here.
Makes sense. It's making sense.
So I'm happy that we're able to round up the session. I think this stuff is recorded. Please, and from the next session, always record your own too, because I don't know what's doing this my Zoom. Sometimes it will not record.
Okay.
So these are based on God inspirations and based on things I've come across during this course of studying materials from people. So I told you that this ABCD pattern was from family of harmonic patterns.
What are the time frames for this kind of trade
Only
is
on the daily
daily?
time frame, daily and 4 hour, daily and 4 hour, daily and 4 hour. That's all. You can see that if you go to daily time frame now, this is 2 hour. If you go to daily time frame, like I said, this is clean, very clean, very clean, clean. So they are all here. You can see your ABCD, right? They're everywhere. They're everywhere.
Yeah.
Break of structure. Break of structure. You can have break of structure. So A, B, this is C. Even though this took out this guy, is still considered break of structure. Push down. Even as it's coming, they have A, B. Even before here, I made mistake, sorry. Our time is almost off. So next session is gonna criteria for entry A, B, C, D. And it gave birth to another A, B, C, D. Break of structure. Break of structure. Always look for break of structure. See this one again. A, B, C, D. Break of structure. Break of structure. Always look for break of structure before your pattern. And then you have to now use Fibonacci 2 to look if this is up, if your C point is up to 0.382.
So the first thing is to find the break of structure, then
Uh-huh.
mark your points A, B, C, D. Then
Exactly.
thirdly, look for your
Fibonacci to know if your C point
use
is
your
up to
Fibonacci use Fibonacci to confirm
the C point.
C point if it's between 0.38 and 0.618.
Exactly.
Then thirdly, you find your other block.
On
That's
the
your
D
point of
point, yes.
view
Wait for
on
price to
the D
react from
point,
there.
the
Exactly. That's
C
all.
to your C point or
That's all.
above.
That's all.
Make a write down. Or did you write it like this?
No, no, no. You can write it now.
Okay.
But that will be because you're almost done. We are done. This how many minutes? 4 minutes left.
4 minutes
So
remaining.
let me run through the chart examples. You can see all of them here. So have A, B, C, D. Break of structure. Price react from higher time frame support level. Respected it will have. This is what I talk about pin bar. This is a pin bar. You can see this pin bar. We call it a rejection block. This middle candle, that doji candle. That's what we call rejection candle. So that's what we call rejection candle. Sorry. So that's all. This candle, that's what we call rejection candle. This middle candle then confirming with this push to the right hand side. So At that point, you can be able to now take your entry from that point. So that's just it.
Fine.
So we are
Okay.
done. So we have 3 minutes left. So they're everywhere. A, B, break or structure, C point. You can see that price came and mitigated an imbalance here. We have a confirmation.
Yes.
We sold.
To see points.
Even as you are selling to C points, take profit. This took days. Oh.
But
Then we now
how will
have
you mark? How would you mark your stop profit? I
stop
mean
loss.
stop loss.
Stop loss is always below this. You can put it anywhere below this range. There is no definement for stop loss now, but make sure your stop loss is at least 50 pips away, 50 pips away, 50 pips away from your entry, 50 pips away minimum, because it's a swing trade. So price, you have to give room for price to also react. Price will come down, go up and all that before moving in your direction. So we are done. 2 minutes left. Even as price is pushing up, it's also creating ABCD.
Okay.
A, B, C, break of structure. We have imbalance. We have our order block here. See our order block, right? See this order block.
Yes.
Price came, reacted from there,
So
gave
you
us
can even put your take profit there.
exactly. You can put it there. Then we also have one above here. So that is where price reacted from. This the D point before we now start pushing down. So that is how this is.
It took how many months before you reach there?
No. It will only take days. It will not take months, so it doesn't take months. It takes days. We'll have couple, let's say 2 weeks. As it's coming down, now you're in trade already. You're making money now. You're already making money. You're waiting for another money to come again because you always see it every time in the market. It's always there. You always see it every time in the market. It's always there. So they are everywhere. They are everywhere. They are every see this one that is running. This one is very sweet one. Back to back, like back to back to back to back. You're
See
just
the way your voice thick.
you're,
Your
you're,
voice.
you're taking it back to back to back to back. Like as it's coming there, you're selling. As it's going up, you're waiting for you, you're selling. Yeah. This trade bar, this AUD CHF. Okay, AUD USD, very sweet pair. Oh, like mitigation, D points, break of structure, ABCD. You rise. In fact, as of this morning, it's still pushing down. I think I even shared something about it this morning, sir. So I was watching that guy video ABCD pattern. This is a screenshot I got. He didn't even mention of all this because there was nothing like this during that time. This was a sweet trade. ABCD pattern. Mitigation of order block on the daily or so. Push to the upside. See all of them here. ABCD. Break of structure. Mitigation of order block in balance field. Price pushed up. Then you can see another ABCD too. Mitigation of this order block. Price is pushing down. ABC